All right, today we're going to dig into Methode Electronics, ticker MEI. Now, their latest earnings report might look a little confusing on the surface, but trust me, it tells a really fascinating story about a company that's right in the middle of a huge turnaround.
And this slide right here gets to the heart of the puzzle. Methode beat on revenue, but they actually missed on their earnings per share. Now, normally, that's a recipe for a bad day, a big sell-off. Instead, the market sent the stock soaring. So the big question is, why? What on earth did investors see that wasn't in those headline numbers?
So to solve that puzzle, let's first break down the headline numbers, because that's where this whole contradiction starts. Okay, first up, revenue. Methode brought in $240.5 million. Now, that was actually down 7% from last year, but, and this is the really key part, it came in comfortably ahead of what Wall Street was forecasting, so a solid beat on the top line. But then we get to the bottom line. The company posted an adjusted loss of 22 cents per share, and this was just a hair worse than what analysts were expecting, so it was a slight miss. So right now, what we've got is a beat on sales and a miss on profit. Kind of weird, right? And yet, this was the market's verdict. A massive 12.2% jump in the stock price. Wow. I mean, that is a powerful signal that the market was focused on something much, much deeper than that tiny earnings miss. So here it is, all in one place. You've got a beat on sales, but a miss on profit. Clearly, investors looked right past that small earnings miss. They were rewarding something else entirely.
And that brings us to the real story here. See, it wasn't about the headlines. It was about the incredible execution that's happening behind the scenes. The market saw clear proof that Methode's turnaround plan, it's not just talk anymore, it's delivering real results.
And you don't even have to get my word for it. Management's message was so clear and so confident. The CEO himself came out and said the transformation is firmly on track. That one idea right there is what anchored the whole bull case and got investors excited.
This slide really shows you the two sides of the coin. Yeah, on the left, you've got that top-line pressure. Sales were down 7%, mostly because some old programs are ending and the EV market's a bit soft. But look to the right. That's the real story. Even with lower sales, their adjusted operating income was actually up. How? Just incredible cost discipline. This is the core of the whole thing. Methode is becoming a leaner, more profitable company. And here's the proof. I mean, look at this. The company is generating strong free cash flow. We're talking $18 million of actual cash this quarter, and they've done it for 3 quarters in a row. They're using that cash to pay down debt, almost $41 million of it over the last 9 months. At the same time, they're slashing their overhead costs. The takeaway here is crystal clear. Management is laser-focused on fixing the balance sheet. All this fantastic execution is giving management the confidence to guide higher. So let's take a look at the road ahead and the growth drivers they've been talking about.
Okay, now this chart is just incredibly telling. The company expects its EBITDA margin, that's a key measure of how profitable their core business is, to nearly double in fiscal 26, to go from around 4% to almost 8%. That signals a massive amount of confidence that their cost-cutting is not only working, but it's sustainable.
And you know, this turnaround isn't just about cutting costs. They've got some real growth engines firing up too. Their data center business is going strong, up 12% from last year. That's fantastic. On top of that, they've got over 30 new customer programs scheduled to launch this year. And while the North American EV market is a little soft right now, they see a big rebound coming in fiscal 27. So you've got this clear, multi-pronged path back to top-line growth.
So let's put it all together. The weird headline numbers, the amazing operational turnaround, and that really strong forward guidance, and get to our call on the stock.
Based on all the evidence we've seen of this successful transformation really taking hold, we are rating the stock outperform. The market's positive reaction seems completely justified by the huge improvements we're seeing in the business. So here's the bull thesis in 4 simple steps. First, by cleaning up the balance sheet, they're making the stock a much safer investment. Second, their cost discipline creates what we call operating leverage, which just means when sales do start growing again, profits are going to grow even faster. Third, that data center business is a solid, reliable engine for growth. And finally, and this is maybe the biggest takeaway, the market has shifted. It's now rewarding Methode for smart, disciplined execution, even when the sales environment is a little bumpy.
As always, our analysis is for informational purposes only. This is not financial advice.
And that leaves us with one final thought. For years, the market story was all about growth at any cost. But Methode's quarter raises a really important question. In today's market, Is disciplined operational execution the new growth story? It's definitely something to think about. Thanks for joining us.